Sticking with the markets, our next guest says last week's eco data points to some further signs of a soft landing and says to believe the Fed's message that a rate cut will not come until the second half of 2024. What does that mean for a market that has been on a roll in the last few weeks? Joining us to discuss here at Post 9, BNY Mellon's head of U.S. macro, Sonia Meskin. Sonia, welcome. It's good to have you. A lot of discussion about what Powell told us on Friday, particularly the line about being well into restrictive territory. Are we in a phase now where we kind of know what they think they want to do, but they can't afford to say it out loud?
It's possible, it's very possible. But what we really need to see, what we've seen so far, is that inflation has decelerated faster than we were afraid it would happen in 2022, right? So the sacrifice ratio, so-called sacrifice ratio, where unemployment needs to go up by a certain amount for inflation to come down, has been much smaller than was feared a year ago. And if this trend continues, the Fed may very well start cutting rates sooner, but it does need to continue, in fact, in 2024, and I think that that's an open question.
Do you expect it to continue?
We think that there may be certain factors that may be conducive to inflation decelerating this year that may stagnate or even reverse in 2024. So we may, in fact, hover above this 2% core PCE mark for quite some time in 2024. And that would, of course, induce the Fed, all else equal, to start cutting rates later rather than early in the year.
Morgan Stanley insinuating in a note that when the Fed does begin to cut rates in 2024, they're assuming that's a definite thing. It is still maintaining a certain level of restrictiveness, that it's not until 2025 when the Fed would move toward an easing cycle. Can you help explain kind of the difference between just cutting rates and then having a bona fide easing cycle? Because I think that helps inform our viewers and investors in terms of the difference here.
Yeah, of course. I think the difference really is in nominal versus real rates, right? And the real rate is nothing else but the rate of growth plus minus inflation. So when we look at inflation decelerating, that means that, and the Fed is maintaining a relatively high nominal rate, that means that the Fed is actually being restrictive. Now, the Fed doesn't know how sustainable this deceleration in inflation is, which is why they're coming out and saying we want to stay restrictive for longer, just to be sure inflation doesn't reaccelerate, because we're still at a very low unemployment level. Right? But it's tough to say into 2024 at which point they will decide, well, we're sufficiently restrictive, let's start cutting, and at what pace we should keep cutting.
Do we think that Waller's comments last week are consensus, that we can have this sort of benign series of rate cuts?
It's certainly the ideal, and it's certainly consistent with the notion of a soft landing, which I think the markets have priced in, and which I think as the chances, the objective probability of that has risen, given the developments in inflation and employment. But it's not a 100% guarantee. Right, there's still risks. The risks are on both sides, I think, of the distribution are a little fatter than normal.
If the market is prematurely excited about rate cuts, what does that risk look like at this point in time, as in terms of the way that the markets are currently pricing things in?
Well, I think you guys, you've mentioned that there's been some broadening out in market equity performance, and that's very, very encouraging. But really what we would like to see is not just the Magic 7 outperforming, but this spreading to smaller companies that are not necessarily very levered to AI specifically. And they've been more stung by higher rates, and especially as refinancings increase next year, it would be helpful for them if nominal rates decline, because they finance themselves in nominal terms, of course.